Imagine this. You're 25, and every dollar you earn is starting to work for you. Your money is compounding, growing, building wealth in the background. Now imagine the opposite. You missed out on massive opportunities by making a few simple mistakes that you could have easily avoided. Sounds scary? Well, today, we're diving into the top 5 mistakes to avoid when starting your investing journey so you can live that life you're dreaming of without regrets. Trust me, you don't want to miss this. Mistake number 1: investing can be intimidating, especially if you're in your 20s or early 30s, and with all the noise online, it's easy to feel lost or overwhelmed. But remember, the right moves now can set you up for life. So, today, let's make sure you're equipped to make smart choices by avoiding some critical yet common investing mistakes. Ready? Let's jump into it. So, first up, and this one is big: waiting too long to get started. Look, I get it. Life's busy, money's tight. But every year you wait, you're losing potentially thousands of dollars. Compound interest is like your secret weapon. The earlier you start, the more powerful it is. And trust me, your future self will not appreciate you saying, "I'll start later." Can you imagine telling your 40-year-old self, "Oh yeah, I thought TikTok was a better use of my time back then"? Yeah, not great. Plus, the best time to start investing was yesterday. But if not yesterday, when? Mistake number 2. Let me paint a picture for you. Imagine putting all your hard-earned cash into one single stock, thinking it'll make you rich overnight. Sure, it might, but if it tanks, your entire investment is gone. That's why not diversifying is one of the biggest rookie mistakes. You need a mix. A little bit of stocks, maybe some bonds, ETFs, even real estate. Diversification isn't just some fancy finance word, by the way. Think of it as the "don't put all your eggs in one basket" rule. And in the finance world, broken eggs aren't something a paper towel will fix. And that brings us to something almost as important as diversification itself. Mistake number 3. Let's be real. Predicting the stock market is a bit like predicting the weather. Sure, you can guess, but you're never truly sure. Trying to time the market is not only risky, but it can also cost you a lot more than you realize. Studies show that those who simply stay in the market tend to fare better in the long run than those who constantly buy and sell. I mean, are you really going to outsmart millions of analysts and computer algorithms who do this for a living? I don't know about you, but my track record on winning the lottery isn't exactly promising. So, instead of timing the market, focus on what you can control. Mistake number 4. Ever made a choice because you were either super excited or totally scared? Yep, emotions can wreck your investments. When the market drops, panic can make you want to sell everything. When it spikes, FOMO might tempt you to go all in. But emotional investing often leads to big losses. You have to stay steady, like a captain sailing through a storm. And don't worry, it's not just you. Everyone wants to hit the jackpot with Host. Let me paint a picture for you. Imagine putting all your hard-earned cash into one single stock, thinking it'll make you rich overnight. Sure, it might, but if it tanks, your entire investment is gone. That's why not diversifying is one of the biggest rookie mistakes. You need a mix, a little bit of stocks, maybe some bonds, ETFs, even real estate. Diversification isn't just some fancy finance word, by the way. Think of it as the "don't put all your eggs in one basket" rule. And in the finance world, broken eggs aren't something a paper towel will fix. And that brings us to something almost as important as diversification itself. Mistake number 5. This might surprise you, but those little fees can quietly eat away at your investments over time. From brokerage fees to expense ratios on funds, every dollar spent on fees is a dollar not working for you. And over decades, those dollars add up. So make sure to pay attention to fees and understand how they affect your returns. Ever feel like your account balance just doesn't match the amount you invested? Yeah, That could be fees sneaking in. Ask yourself, am I investing for myself or to help fund someone else's yacht? So, there you have it. The top 5 mistakes to avoid when starting to invest. Avoid these, and you'll already be miles ahead of most people in building that wealth you want. But it doesn't stop here. Every decision you make in investing, starting now, will shape your future. Don't leave it to chance. Remember, every dollar you invest is a step toward the freedom, security, and lifestyle you're dreaming about. Don't be one of the people looking back, wishing they'd taken action sooner.